Hey, everybody, we're going to talk about some of our favorite stocks with the falling rate environment. If you aren't familiar, the Federal Reserve just cut interest rates for the first time since March of 2020 and did so at a more aggressive pace than a lot of people were expecting. So far, we've already seen this kind of trickle into some stocks. The real estate sector is up nicely, for example. A lot of people are very optimistic about all other housing stocks, about all these rate sensitive companies. Dividend stocks in general have outperformed since the rate cut. But we think this could be the trend or the start of a trend that really kind of takes time to trickle into some of our favorite companies. Tyler's joining me. We're both going to be talking about some stocks that we think could be big beneficiaries of falling rates. Before we dive in, please take a minute and check out fool.com/Frankel, the link you see on your screen. Get the top 10 stock ideas from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So I'll talk about mine in just a second. Tyler has an interesting one. I know Tyler is not a big fan of my favorite home builder, but I think we can both agree that it's a great environment for home builders, number one. And number two, that falling interest rates could have very positive tailwinds for all home builders. Um, but there's one in particular he has his eye on, and he told me before we recorded, it actually hasn't been one of the best performers lately. So why Tyler? Which one is it, and why do you have your eye on it right now?
Yeah, so I've been looking at LGI Homes. Ticker is LGIH. The reason that I have been looking at this one in particular is, well, I mean, I could use any reason. Rate cuts, rate increases. I'll talk about housing because I think housing is or home builders is one of the better places to be making money these days in the market. But LGI in particular was one of the ones that we saw with home builders, like that wild swing of like 2021, that giant boom in people wanting to buy houses because they wanted to get out of the cities and kind of, that sort of thing. LGI Homes would just, sold an insane amount of housing for their size of a business during that time. Part of the reason being is that LGI focuses specifically on new build homes, or sorry, first time home buyers. So lower price point. Their average selling price is about $350,000, which for home builders these days is on the lower end of the price curve. It sounds high, but that's kind of the base for a lot of places if we look on a national average. And so what ended up happening is because they went so hard into 2020, 2021 with sales, they basically blew through their entire inventory of homes and like land to sell. uh, it takes time to develop land or acquire, develop, get the houses actually up and built, such that if you sell at an accelerated rate, you're going to deplete your inventory pretty fast, and that's what happened. In 2021 or 2020, excuse me, they had about 111 communities. Active communities where they were selling houses. And then by 2022, they were down to 91 because they had basically blown through inventory so fast, and they couldn't replenish it fast enough. And that was part of the reason why these past couple of years have been, so tough for them relative kind of the other home buyers, is because they basically didn't have anything to sell. Like we've seen with home buyer or home builders, there has been demand because it's been really the only outlet for the housing industry, with existing home sales being so low. But LGI was almost in the same situation as the existing home market, where they didn't have anything to sell to the market relative to a lot of other people. And then you toss in higher interest rates, which for its particular demographic of buyer, they're going to be much more cost sensitive. So a couple swings in a percentage point of interest rate is going to be a huge determining factor for them, versus somebody who may be doing a move up and have some home equity already built up. These, first time buyer, it's going to be a little bit harder for them. Despite the big slowdown in sales, they went from $3 billion in sales in 2021 to about 2.2 over the past 12 months. Despite that, margins have stayed relatively well. They did 24% gross margin, 12% net income margin, which are relatively good. Despite having probably a little bit more staff on staff because of the lower sales volumes. But what's so interesting to me about them right now is they have this massive ramp up coming. They spent a lot of money in 2022, 2023 to resize their inventory and get ready to actually sell into this market. And by the end of the year, management expects them to go from their current community count, which is 115, to 150. They are currently training about 60 sales staff, which for LGI is pretty considerable in terms of total sales staff. Once they get through their training programs, they're going to send them out to these new communities and they're going to try to hit the ground running here. I think that for a business that has, I would say been a little bit down on its luck for the past couple of years because of, very varying issues in terms of sales and inventory and whatnot. I really think that this company has a opportunity over the next year or two because of where they have positioned themselves to do incredibly well, even relative to home buyers or home builders in general. On a stock pricing kind of metric, they're trading for about 14 times earnings, which is actually kind of high for home builders right now. But I think because there is so much expected growth coming from all these new sales agents going online, all these additional community counts, we could see some pretty considerable upticks in sales in early 2025 and into the selling season, into the spring and summer.
Yeah, so mine that I wanted to talk about is a bank stock, Bank of America. It's my second largest bank stock. I was actually surprised to see Wells Fargo is now the biggest in my portfolio, but I think Bank of America could be a big beneficiary of falling interest rates, and for a few reasons. So let's start with the more obvious ones. There's the deposit tailwind. So over the past 2 years, Bank of America's deposit base has contracted by 5%. That's the first time that's happened since I've been following the stock. And the reason is kind of simple. In the rising rate environment, these online banks became a lot more appealing. If I could get a CD for 5% and Bank of America is offering 1%, I might be inclined to take my money out of Bank of America and go over to SoFi or one of the other online banks that's paying more. Same with high yield savings accounts. Now, 2 years ago, when the average 1 year CD was paying 0.5% even from an online bank, there wasn't that much switching pressure. As rates fall, it'll be less tempting to keep money, and more. And let's be honest, online banks are generally less convenient than a big bank like Bank of America, all things being equal. And as the interest rate environment comes down and that part of the business is more equal, it will be a little more easy for Bank of America to retain or hopefully even attract new deposits. So that's number one. Number two is interest yields. Bank of America's net interest yield is down by 13 basis points over the past year. And without getting too deep, the simple explanation is that rising deposit costs have outpaced the rising yields on its loan portfolio. Um, you know, think most of the loans on Bank of America's books are mortgages, auto loans, things that are multi-year, long-term loans. Meanwhile, the deposit cost changes pretty immediately in response to interest rates. In terms of CDs, in terms of corporate deposits, which is a big interest expense. So as interest rates come down, deposit costs will go down, but the yields from the loan portfolio will generally stay the same. That results in higher margins. Essentially, at least in the immediate sense, it takes a lot longer for the loan portfolio yield to react to the interest rate environment than the deposit base. Number three is consumer confidence and loan demand and things like that. Tyler and I, in another video, were talking about demand for things like home equity loans and home equity lines of credit and cash out refinancing of mortgages. Americans are sitting on more home equity than ever before and are generally not using it because it's expensive to borrow money. As it becomes less expensive to borrow money, Bank of America, which is one of the largest mortgage lenders in the U.S., should get a nice tailwind from that. Number four, just general consumer tailwinds. We've seen default rates tick up quite a bit recently. As consumers have more borrowing options, we mentioned home equity lines and things like that. It'll be easier for consumers to keep up with things like their credit card bills and auto loans, and just generally having more options and more accessibility to cash is a nice positive tailwind for loan performance. And number four, last but certainly not least, um, this became a big issue in the bank failures we saw last year, in that fixed income assets on banks' balance sheets are not worth as much as they were when they were issued. If Bank of America issued a mortgage, 5 years ago at a 3% interest rate, that mortgage would not get its face value on the open market if you were to sell it to another lender. So as rates fall, the the pricing, the valuation that of Bank of America's fixed assets on its balance sheet will improve. So there's a bunch of different positive catalysts from a falling rate environment. Again, that was a very high level overview. I don't want to get into the dynamics of how fixed income assets are priced, but generally speaking, if you own a bond, the lower interest rates make your existing bonds more valuable. So there's a few different reasons why Bank of America could do really well in a falling rate environment, and right now is a great time, I think, to get in. And I'm not selling any of mine. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.